Friends, this Friday, Wall Street faces the biggest wealth trial of 2026 so far. Drop any illusions about a soft landing right now. I just got hold of Citigroup's global strategy report. They showed their cards. US unemployment is very likely to smash through the 4.7% life or death red line this Friday. Hear me, this isn't a routine data wobble. It's the physical trigger of the SAM rule. If that 4.7% pops on the screen, the US economy will be officially judged to be in recession. And the most absurd and most deadly opportunity is that Wall Street is still pretending to sleep. Market pricing still naively bets the Fed will only cut about 60 basis points in 2026. But Citigroup's death sentence says, to save the system, the Fed will be forced into violent cuts of well over 100 basis points. That 40 basis point gap is the huge cognitive crack, our generation's biggest wealth transfer window. When Friday's bell rings and the prettified soft landing lie is brutally punctured by 4.7%, trillions of wrongly placed bets will instantly vaporize. And the hunters who read the move will catch this tidal wealth in an epic short squeeze across bonds and gold. But will that red line actually break? Or will the Stats Bureau, the one with the eraser, allow it to break? You don't need Citigroup's report to know. Your body sensed this systemic chill long before Wall Street did. Ask yourself, why do headlines shout GDP growth while your buddy who wants to switch jobs sends resumes for 3 months with nothing? Why is the empty desk of a departed colleague collecting dust while the boss won't even mention hiring? Why are middle-class people downgrading spending while data says the job market is sizzling? There's only one answer. We're living through a statistical boom, physical bust. The cruelest irony in this game isn't recession itself. It's that we're kept in the dark about how fast the recession is actually coming. Because the Bureau of Labor Statistics is playing a clumsy magic trick. Right before Friday's release, a ghostly detail surfaced. Data from the past months has been heavily revised downward. If you dissect their appendices, like a forensic analyst, you'll see the so-called strong jobs that push stocks up quietly evaporated by 60,000 months later. This isn't an error, it's retroactive fraud. They publish a pretty fake number to pump the market, then months later, when no one's looking, they quietly change it back. It's like buying a car whose odometer reads 50,000 miles. After you pay, the dealer texts, oops, actually it's 150,000 miles. How do they conjure jobs out of thin air? The trick is the infamous birth-death model. The model assumes, because the Bureau can't track every tiny business in real time, they assume that if the economy moves, new companies are definitely being born. In good times, that assumption is fine. But in this high-rate strangulation era, that model is a digital pump. Reality, your local cafe closes, a startup dissolves. Yet the Bureau's spreadsheet assumes, I don't see it. But I believe new hires must be happening somewhere. So even while the real economy bleeds, their sheets keep birthing thousands of non-existent phantom jobs. That's why your experience and the data are split. Your pain is real, that prosperity is fictional. This Friday, that life faces final judgment. If Citigroup is right and unemployment hits 4.7%, it means even the data pump is overloaded and can't hide the hole anymore. Then Wall Street's trillions betting on a soft landing will discover they're holding toilet paper. If the Bureau's statistical fakery is the painkiller that hides the illness, 4.7% is the ICU notice. And the person who will hurt the most isn't the newly unemployed, it's the Fed chair, Jerome Powell. He's trapped in a classic central bank prisoner's dilemma. For years, Powell told markets, we'll keep rates high until inflation is dead. He cast himself as a Volcker-style tough guy. But if Friday's unemployment smashes 4.7%, that tough act will crumble. Why? Because the Fed has two sacred cards, price stability and full employment. Now prices are barely stable, but jobs are collapsing. Historical tests of the SAM rule show that once unemployment crosses the critical point, recession probability is 100%, not almost, but 100%. Then Powell has two choices. Keep rates high and play tough. That risks a hard landing and a Great Depression-style outcome, making him a historical villain. Or he folds, kneels, and launches violent rate cuts to stop the bleeding. Which will he choose? No matter how tough he talks, his body will choose the latter. Citigroup's core logic is right here. The market prices in small, 25 BP insurance cuts. Reality will demand life-saving cuts, 50 or 75 BP at once, multiple times. When Friday's numbers force Powell to admit I blew it, the Fed's pivot won't be a gentle turn, it will be a drift. Some analysts even predict 2026 cuts could jump from the market's expected 60 BP to over 150 BP. The market's battleground isn't about whether the data itself is good anymore, it's about how big that expectation gap really is. When the Fed's decision logic violently rips away from the real-world unemployment red line, trading off a few public news blurbs makes it truly hard to see the real escape routes and entry points amid trillions of money stampeding. I've packaged the logic I broke down today into a guide called 4.7% Red Line Escape Manual laying out a systematic comparison of possible moves. I've dropped the manual in the comments. Click to claim it. Hats out of consensus. All massive windfalls are born in that stretch. That's out of consensus. All massive windfalls are born in that stretch. Now let's bring macro logic down to your wallet. Where is this generation's biggest wealth transfer hiding? It's hidden in the mispricing of US Treasury yields. The 10-year is still pinned up high around 4.0% to 4.2%. Why? Because fund managers with billions still buy the Powell story and bet on a soft landing and inflation rebound. They arrogantly think such big cuts aren't needed. But if Friday's unemployment spikes to 4.7% and Citigroup's prophecy comes true, what then? It means they were all wrong. Their short positions are lambs to the slaughter. If the market realizes the Fed must cut 150 BP, what happens to yields? They'll fall like a kite with its string cut. From 4.2% straight down to 3.5% or even 3.0%. When yields drop, bond prices explode. For long duration, leveraged products like TLT or more aggressive 3x that's not a few points. It's 30% or even 50% moves. That's cognitive arbitrage. You don't need to be smarter than Wall Street. Just earlier in seeing the recession, when they scrambled to cover shorts after Friday's print, you want to already be at the peak selling into them. It's legal robbery. Besides bonds, another asset will be deified by Friday's judgment, gold. Many buy gold as a good luck charm or inflation hedge. But with a 4.7% unemployment backdrop, gold's logic changes. It's no longer jewelry, it's a short on Fed credibility. Think, if the Fed must unleash a fresh round of money printing and cut rates to the floor to save jobs, is the dollar still worth holding? When real rates plunge into negative from violent cuts, holding cash is slow death. Money will flee like a startled flock. Gold, the one hard currency the Fed can't print, becomes the only refuge. Citigroup even put out an aggressive target if unemployment runs wild. Gold could break $3,000 in H1 2026, even touch $3,500. This is more than hedging, it's a global capital no confidence vote against the dollar, a silent monetary uprising. So when that red line breaks, expect a total decoupling of gold and the dollar down. Gold up because what's rising isn't the metal. It's fear of fiat collapse. The outlook is clear. This isn't complex macroacademia, it's a simple bet. The Fed and the Labor Department try to prop up the game with fake numbers. But the rest of us, you, me, and Citigroup already see the bottom card, 4.7% unemployment. Friday is the reveal. If the data bombs, it's the Fed's surrender and a bond gold bull party. If the Bureau keeps faking and data doesn't explode, that only delays the execution. Physics-level recession can't be hidden forever. So, in this calm before the storm, what can regular people do besides watch? Don't worry, next I'll show you how to bet in this game. Not to gamble your life, but a concrete, actionable survive and prosper code. Ready your accounts? Since we can see the cards and expect Powell to kneel when 4.7% hits, where should we put our chips to catch this windfall? The first, and highest probability, code is US Treasuries, specifically long-duration Treasuries. Bonds put people to sleep, but that's ignorance of financial physics. On the eve of recession, long bonds are in T for retirees. They're explosive call options. This is math, not mysticism. Bonds have duration, how sensitive price is to rate moves. To fully explain, I must bring in an indicator only top traders care about. Convexity. Think of it as the bond's price acceleration. In recession trades, long bonds are king because they have huge convexity. That means asymmetric moves. When rates fall, long bonds rally more than they fall when rates rise. Got it? It's like flipping a coin where heads wins $100 and tails loses $60. Over time, math wins. With Citigroup's 4.7% red line, the odds of heads just jump to 80%. If the Fed cuts 2% to save the economy, long bonds get a rocket boost. This isn't investing, it's copying the answer. Take a 20-year Treasury ETF, duration approximately 17 years. So, theoretically, every 1% rate cut means approximately 17% price gain for TLT. If Citigroup is right and the Fed cuts 2% in 2026, a classic recession play, TLT could rise 30% to 40%. If you use 3 by TMF, you're talking doubling returns. Also, buying long bonds locks in yields. The 10-year sits around 4.2% now. Some say money market funds pay approximately 5%, so why buy bonds? Big mistake. Cash yields are floating. If the Fed cuts, your cash yield falls fast. If you buy a 10-year now, you lock 4.2% for 10 years. No matter if Powell cuts to zero, the Treasury still owes that 4.2% coupon. In a low-rate future, that contract is like gold. Smart money is hoarding long bonds. They're not buying yield so much as securing the future high ground of cash flow. Who's on the other side? Those clinging to the hope that rates stay high. They're selling bonds and pushing yields to 4.2%, like drunk people tossing away gold. You just bend down and pick it up. We bet on gravity. 4.7% unemployment will pull rates down. When market hears the recession alarm, those who mocked bond buying will beg to buy from you at higher prices. That's bond physics. The second survival code is gold. If bonds are the spear, gold is the shield, even your ticket on Noah's Ark. Remember, no fiat credit currency survives a full long debt cycle. If the Fed must print to save employment, your dollars, euros, yen are being diluted. This gold bull is different. It's driven by a credit crisis, not only inflation. Look at $38 trillion of US debt and $1 trillion annual interest. Classic light-stage Ponzi signals. Roll new debt to pay old debt and interest compounds until only printing can erase it. When the Fed is forced by Friday's data to cut, it's declaring, I'll save the economy even if it destroys the dollar's purchasing power. That's betrayal of savers. Gold is the rebel's totem. No government backstop, no default risk, physical consensus. Buying gold is shorting the fiat machine. I don't trust your printer. I trust physics. So is gold expensive now at tilde? $1,440 per ounce? If you don't see the game, it seems high. Citigroup's target next year is $6,000 or more. Why? Because with unemployment at 4.7% and real rates below zero, gold has no opportunity cost and becomes the only countermeasure to fiat collapse. The smartest players, central banks, are already moving. This is geopolitical and more dramatic than financial data. Since SWIFT's weaponization and Russian asset freezes, Global South countries learned dollar assets can be unsafe. Your bonds can be frozen, your deposits wiped. Only physical gold in your vault is truly yours. So China is buying, Poland is buying, Turkey is buying, India is buying. Sovereign funds are quietly moving gold bricks home. This is a silent de-dollarization. When central banks buy gold, retail shouldn't be foolishly betting on paper money. Follow the central banks, it's rarely wrong. After Friday, if the red line breaks, gold isn't a metal, it's survival insurance. Buy it not for return but for the right to survive. Finally, a big skull and crossbones warning for everyone wanting to catch a bottom in stocks. Many think rates down, stocks up. That's a lethal trap. Buying US equities now is catching a flying knife. You ignore a major lag effect. 2 years of high rates have poisoned corporate bones. Even if the Fed cuts, it's like giving aspirin to someone with a heart attack too late. 2026 is the corporate debt maturity wall. Tons of cheap debt matures and must be refinanced at higher costs. If that hits alongside a consumption collapse from 4.7% unemployment, revenue dries up while interest costs rise. That causes mass blowups of zombie companies propped up by cheap debt. Russell 2000 small caps could see bankruptcies queue up. That panic spreads to big caps. Even Nvidia and Apple aren't immune. Don't judge by PE. Look at cash flow and who can survive this debt tsunami. Early in a recession, stocks destroy wealth, not create it. With the 4.7% red line looming, US equities face earnings and valuation kills. So cash is king, but not fiat cash. Hold cash as assets, short-dated bonds, gold. Don't try to catch falling knives in the stock market, even if they look cheap. In a recession, the floor has basements under the basement. Friends, 48 hours. That's our last prep window. This is more than a non-farm payroll release, it's the tone setter for all of 2026. The 4.7% red line will split people into two camps. Those asleep in the data fog who watch their labor earnings be eaten by inflation and recession. And the hunters who smell blood and quietly hold positions in bonds and gold waiting for the Fed to surrender. If you got what this video is about, you know what to do. No complex moves, just see the irreversible trend. When Friday's bell rings and that red number flashes on the screen, I hope you're the one popping champagne, not the one frozen in panic. Wall Street's biggest gamble is dealing. The cards are dealt. Will you call? I'm Iron Bull Finance. See you on the other side of the red line. Right now the market is basically floating on a digital bubble, pumped by the birth-death model. And the reason for 0.7% unemployment is called the life or death line. That it's not just the SAM rule trigger. It's the physical switch that flips the Fed from a tough-eye stance into emergency rate cuts. To help you map today's asset coordinates more clearly, I put together a 4.7% red line escape manual. It's more like a briefing for a complex situation, helping you turn what we covered today into concrete allocation boundaries. I've already put the manual in the comments. Click to claim it.